Let's take a look at some information and charts on Ethereum for Brave New Coin. So Ethereum is currently a proof of work coin, one of the earlier ICOs, one of the most profitable ICOs. Minted a lot of millionaires rolling into billionaires here. And it's currently nearing a hash rate all-time high for proof of work. This is set to change to proof of stake at some point in time. The thing is with ETH, you never know when exactly changes are going to be made. You don't know what exactly the effect of those changes will be until after the fact. I said the same with the EIP 1559, and I'll get to that in a second. But we don't know what we think we know until it happens. So we might think that proof of stake is going to be great for ETH, but how that may play out is probably different than what a lot of people are expecting. So just be nimble and mindful of that. Not saying it won't be bullish, I'm just saying for the network, things might be vastly different than what is initially predicted. So that's not coming for probably a couple of years from now. That's why hash rate has continued to recover. Hash rate overall, zoomed way out, is at a massive all-time high still. You can see there was some China stuff where hash rate came off. There was some price stuff where hash rate came off, but all that is basically recovered at this point in time. And if we look at the available ASICs, now most of ETH is probably GPU mined. I haven't seen reliable stats on percentages here, but if I had to guess, a heavy percentage of it is GPU mined versus ASIC mined. Now there are two ASICs coming eventually. I don't know how you're going to get your ROI on this before we go to proof of stake for ETH, but maybe with the fees being high enough, then miners recoup those costs quicker. They take on more risk currently to buy those. You know, let's say you're taking on loans, right? You're leveraging up to buy these ASICs, and the idea being that you hopefully pay these off quick enough before your interest rates or whatever eat you alive, right? That's one strategy you could employ here. Another reason this hash rate is probably mooning is because there's some covert ASIC activity. You know, ASICs that haven't been released yet but are announced are typically mined on the chain ahead of time. Not always, but just because they haven't been released doesn't mean they aren't mining the chain in some capacity currently. And mining revenue is still extremely high on a relative basis for ETH since 2017. So the security aspect of mining currently is not at risk of anything. I mean, people are still clamoring to get GPUs to mine stuff like ETH because it is so profitable. If we look at nodes, currently 9,200 nodes on the network, although looks can be deceiving because not all of these are independent people. Most certainly, much of this is cloud related, as in Amazon Web Services or Microsoft or whoever else. And that represents a degree of centralization in Fura, for example, a node service that will run these nodes because a full node is over 8 terabytes now. And that is an archival node, not a partial node. The ETH people love to argue that we don't need full nodes, we only need partial nodes. I mean, I hope that's the case, but when you don't have any full nodes, you kind of don't know who the history is or what the history is completely because there's no record of that. You just have partial records of everything, and unless everybody agrees on the partial record, then you're not quite sure. You know, that's where you run into issues with centralization. You need a robust full node archival system, ideally, and that's getting harder and harder for independent people to keep up with. You can say 8 terabytes isn't a big deal. That's probably true, but for most people, they're not going to go out of their way to continually buy storage for full nodes on ETH, is my guess. There are going to be community members who do this, but not a significant amount of people. If we look at transaction counts are down from highs pretty significantly to 1.2 million. Now, historically, this is still at an all-time high, but from the previous all-time high, it's down significantly. Maybe we just cruise here. Maybe this isn't a bearish divergence like I think it is. If price keeps rising on lower and lower transaction counts, on lower and lower active addresses, I get nervous because fundamentally we need sound on-chain metrics to promote price growth for the most part. You can say it's leading or lagging, but in general, you want to see transaction counts rising. You want to see active addresses rising. Average transaction values falling a bit as well. I think there's a lot of just smaller on-chain activity size-wise as fees are semi-reasonable now compared to where they were. If we look at NVT, NVT is rising as well. This is a metric of economic utility inverse. So if this is rising, that says prices more overbought and getting more and more overbought. Definitely not a perfect metric either. Definitely not tooled for ETH specifically. That's something to keep in mind. But you don't want to see rising NVT with a falling transaction count and falling active addresses. Active addresses to 520 from 850, 860 at the high. So those are falling as well. So even though there seems to be a lot of excitement and whatever else happening on ETH with NFTs or whatever, the active address counts and transaction counts tell a bit of a different story relative to where we were pre-May 18th, kind of when everything fell apart. If you look at MVRV in the fill here, it's a metric of market cap versus on-chain activity again. And historically for ETH, an MVRV above 2x or a 2x multiple has been the top or near the top almost every time. Currently, we don't have a lot of room for upside. We're at 1.83. So again, this is looking at on-chain activity, transaction counts, active addresses, movements, right? And it's reiterating what I'm saying in that we can't be super bullish for an extended period of time unless we have robust on-chain activity. And that's what MVRV is trying to tell you. Be careful up here. Things are getting overbought extremely quickly, historically relative to what's happened on the chain. Can this go to 3? Can this go to 4? Can this go to 55? Sure, but it's a probability game. The more price goes up on less and less on-chain activity, it's just unstable ground. We don't have that continued new money effect or exuberance to do stuff with ETH. If we look at block sizes are actually just completely on runaway freight train. And this is going to play a role in the nodes. Again, you're going to see full node sizes just balloon, and that's going to be an issue eventually, right? Nobody's going to care about this now until it's an issue. That's just how things work with human beings. Fees down significantly from the highs, but again, historically, it's between 17 to 20 bucks to send an ETH transaction is high. And we can talk about native units versus USD, but the point is, just to send ETH from address to address is this much. To do anything beyond that is significantly more, maybe a 5x multiple, to interact with smart contracts or to mint NFTs or whatever else. So gas kind of needs to stay in a sweet spot where we're high enough on fees that we're getting towards deflation on the EIP 1559 side of things, and low enough where it doesn't price everybody out. It's very much a perfect or a Goldilocks happy medium situation where you don't want gas to be sub 20, but you don't want it to be more than 100. 70, 50, 60 is probably around somewhere that's reasonable enough where it doesn't price most people out. This is just the gas map. Over the past week, we've mainly held above 30s, 60s. We got, when things get crazy on the chain, when people try to mint a bunch of stuff at once, gas goes to infinity still. So EIP 1559 hasn't helped that. It wasn't tooled to help that. That wasn't the purpose. But you definitely want to see gas stay relatively high. Just means there's activity on chain. The net reduction since EIP 1559 went live has been 35% in issuance, 35% reduction in issuance. So the pumpamentals are strong, right? We've pushed this narrative that everyone's going to be on board with this and things are going to be great and blah, blah, blah. And yet here we are, and only 25% of the network or less has adopted EIP 1559, which means people are overpaying for gas, which means they're burning more. And maybe that was the plan all along. I don't know. If we look at the biggest burners, OpenSea, which is the NFT marketplace, has been the biggest burner, followed by exchanges, stablecoins, and some other NFT stuff like Axie. But it's important to watch OpenSea volume. Here's a chart on DappRadar to look at the volume, because if the volume drops off, then you are burning less because gas goes down, right? And it's just this shark that needs to keep swimming. And if NFT prices go down, ETH prices probably go down, and all this stuff just feeds on itself. It's just a perpetual loop for the better or worse. So you don't want to see this drop. The same reason I don't want to see transaction counts and active addresses drop on chain. There's just less activity is never bullish for anything. So definitely keep an eye on OpenSea volume over the next couple of weeks relative to ETH price, because you don't want to see that drop off. TVL, according to DeFi Llama on ETH, is basically at an effective all-time high or very close. Most of this sits in lending and borrowing type stuff, compound Aave Maker. If we look at the bank's calculations, which I like a little bit better, net value locked is at 61 billion. Aave Maker compound curve, SNX arguably lending and borrowing market as well. DEX is in here. So the usual suspects at the top, over $1 billion in TVL. A lot of that is non-stablecoin related in the DEX department, and then most of that is probably stablecoin related in the lending and borrowing loan area. So generally, I think this is healthy for DeFi. It's bullish, right? You're seeing TVL increase, even though a lot of the underlying is ETH or bullish assets anyway. But we're also seeing borrow volumes increase. So this makes me bullish but nervous because pre-May 18th, we saw that massive long squeeze liquidation spike, basically. And we're setting ourselves up for a bigger one. And this is kind of what DeFi is all about. It's just a perpetual, never-ending long squeeze, because if your underlying on your loan drops in value, then you have to buy more or you get liquidated. So this just is a cascading waterfall effect when eventually it's just too much pain and you have to pay back your loan by hook or by crook. and that has an effect on price. And what you want to watch going forward is liquidation volumes. If these spike anywhere near the May 18th levels, we're going to be in trouble on the price side of things for everything, including ETH. But a lot of this DeFi stuff is going to be in trouble as well. Stablecoin minting is kind of just cruising at 80 billion. Hopefully that's not the top, because for me, even though I don't consider stablecoins DeFi, this means that there's less risk in the borrow because there's not volatility in the underlying asset. There's regulatory risk, certainly, but there isn't price volatility risk for the most part relative to your borrow volume being in SNX or ETH or BTC or whatever. So that's also important. That this keeps growing. USDT maybe is topped out on the chain relative to Tether or relative to Tron because of fees. I don't know, but that's something else to consider as well. ETH exchange reserves, something else I like to look at, continue to dwindle. This probably becomes less and less important of a metric as we get more and more DEX related stuff. From what I know about the data at CryptoQuant, I'm pretty sure this is not decentralized exchange data here, right? This isn't like non-custodial stuff. This is just custodial on exchanges. So maybe this naturally declines over time, but it's still bullish to see this declining with price rising. And ETH in the ETH 2.0 contract continues to rise, nearly at 7 million. So between ETH being squirreled away in this and EIP 1559 going deflationary at points in time, you naturally expect price to go up if demand remains the same or increases as supply is decreasing. You just don't want to see on-chain activity kind of negate these supply effects. You want on-chain activity to continue to hold or increase. Another thing just ancillary to watch is the ETH discount. If this goes back to a premium, which is unlikely, but if it does, then that should be incredibly bullish for ETH. Generally would just represent a bullish institutional picture for people who kind of don't know any better, that they can buy ETH elsewhere. And Ethereum on Google Trends is rising, definitely not at all-time highs like it was in May, but it's definitely up from the lows. So that's not as bearish as some of these other Google Trends, where we're basically back at the baseline. ETH is definitely not at that level currently. Moving to TA, some of the most basic TA you can ever do is fib extensions and measured moves. So we take the high, we take the low. If we're bullish, if we think we're going up, then we put fib extensions up here. If we were bearish, we would put the fib extensions down lower. But if this does make a higher high, if it does make a new all-time high, the bare minimum expectation is that this goes anywhere between 57 and 67, or 5.7 and 6.7. On the next leg up, it already hit its 3K target, which is the 50% from high to low. The next stop is all-time high retest, and then beyond that, this zone. So that's the most basic TA you can do. Then we can look at moving averages. What have those looked like over the years since 2016? Historically, the 1 year MA, the green line, has been a buy zone. Anything below that is a buy. Anytime we get close to a 5x multiple of that 1 year MA, it's been a sell historically. It was a sell in 2017 twice, and it was a sell in April, May this year. Currently, top side is around 8K. By the time it gets there, it's going to be above 8K easily because this thing's going to keep rising. We didn't quite get to that 1 year MA on the downside, and we reversed pretty strongly. So this is still in a very aggressive rising manner, similar to the 2017 kind of double echo bubble, whatever you want to call it. And almost the same timeline too, because this kind of topped out in April, May, and we topped out here April, May, and then still got this retest in December, January 2017, 2018. So I don't think it's unreasonable to think that that's a possibility here. Even as early as December, we could see that, this craziness. The issue with currently is we're a bit overbought. Just like I was saying on the on-chain stats, MVRV, we're pretty far away from the 200-day moving average so quickly. We never did cross bearish here, so we kind of feigned a bear cross. MA's reset completely, and then we got this springboard effect. So now we most likely need to consolidate a little bit. Getting a bear div on volume, bear div on RSI, bear div on MACD. The path of least resistance is definitely up, but at some point people are going to take more and more profit on positions. It's almost a 2x from the bottom, and there's plenty of support on the way down, so I'm not worried that this thing's going to retrace below. Even 2,500 I think is a lot to ask, but at some point this stuff needs to slow down. On the daily cloud, we're actually above the cloud. The cloud isn't bullish yet, and the Kijun is way down here at 2,500. So it's definitely a wonky situation if you're still bullish up here, if you still think we can keep going. The averages are just telling you be careful. The cloud is telling you we're not quite there yet on this time frame, these settings. We're a bit oversold. We're not ready for more just yet based on this. Now this could be wrong easily, but when we go to the 12 hour, it's telling us the same thing. It's saying there's a TK disequilibrium here. The average is down here at 2,500. We already hit that edge to edge move at 3K, which happened very quickly from the triple bottom. And the trailing stop loss based on the fractals, the Williams fractals, basically if you make lower lows, you're out of your trailing stop loss at that point, right? That's at 31. So very, very close to price. So I like this setup a lot because the stop loss is right there in your face. If we go much lower, it's telling you should be out. The TK lines are telling you to be careful up here. All the on-chain stuff is telling you to be careful up here. And there's a very clear rebuy at 25 based on mean reversion, this time from highs to 2,500 as opposed to from lows to 2,500 to 3K. And then on ETH-BTC, it had a multi-week or multi-month kind of triangle flag that has started to break up. This could take a lot of time, but it looks like it eventually wants probably 0.1. Certainly more bullish than bearish. I don't trade this directly. I think it's generally just a mess to trade. There's probably been like 2 or 3 good trades over the past 5 years on this thing. When it has a setup, it's pretty obvious, and then it just goes for it. So keep that in mind. If you're trading this directly, be prepared to get stopped out in both directions, basically. But this does look rather bullish. It's bullish on the pitchfork. It's above big resistance at 0.5, psychological resistance at 0.5. The next psychological resistance would be 0.1, logically. And there's plenty of resistance on your way there. So I'm still leaning towards more of a pullback more than anything here for ETH. Can it keep going? Yes. Can this thing pop up like Solana did on a rising wedge? Sure. But the on-chain activity doesn't really support that. NFT activity falling off doesn't really support that. Moving averages certainly don't support continuation here beyond where we are. So I would definitely be careful especially if you're on high leverage here. Be very careful with any lows. I think everybody's going to be on watch for anything sub 3K certainly, but I think you can cheat it a little bit with a trailing stop loss at 31 based on Williams fractals, and a rebuy definitely at 25 based on the 12-hour Kijun. Lastly, I'll just mention the ETH-BTC fund and DeFi portfolio I trade for Techemy Capital on Enzyme.finance, non-custodial portfolio management tool where you can send ETH/USDC or just watch what I'm doing. You can see AUM, performance, allocation, all of the DeFi coins I'm in, all the yield plays I'm making. You can see deposits, withdrawals. You can see trades, when, where, how much, all that fun stuff. That's all for this one. Like, dislike, comment, share, subscribe. Happy trading.